Well, the thing is, and you're right to say that people tend to bounce around because that happens a lot. You know, that they're not happy with the performance they see in one system, so they jump to the next one that comes across their desk. In terms of the Elliott Wave, just even having it explained to me, I knew this is not something I'm ever going to use. You know, I didn't have to do any back testing or anything like that. I'm just like, you know what, I can't wrap my head around this approach and make it fit with the way I look at markets, and it's just not going to work. So I'm not going to try to force it. But in terms of anything that's technically driven, you have the advantage of being able to go and do a lot of back testing, especially with all the resources we have available to us these days. Even just using Microsoft Excel, which I think a lot of people overlook as a really powerful tool that can let you process a lot of information in different tests in a lot of different ways. If you have to test something that way before you should be thinking about putting real money toward it anyway, to develop the understanding of a system or a technique to be able to apply it to the markets. Because if you just go throwing stuff into live production, so to speak, without having gotten a feel for how it works in different conditions, then as soon as things start going a little iffy, you're going to jump. So once you get past that stage, once you've done your testing and you're confident, you're comfortable with it, and you know that you can execute, you know, according to the plan, and as Mike says, stick to your rules, then if you start, you know, having issues with the trading, you know, once you're live, you can look at it and say, well, is it the system that isn't performing right now? You know, look at, did the system catch the right moves that it's intended to catch, or was it me because I'm just not applying the system correctly? You have a basis.
Well, you know, it's interesting that as you were talking about Elliott Wave, and I know that we probably have a good number of traders on the phone that trade using Elliott Wave. I'd just be curious, Shaun or Mike, do either of you guys use Elliott Wave as a trading style? You know, is it something you found works for you or doesn't? I just would be interested in kind of hearing a little bit more about how you consider that in your trading approach.
I am quite familiar with Elliott Wave, and I am very familiar with all the indicators. But if I may say something before we get into Elliott,
Sure.
All the traders today have become experts, or they are training themselves to become experts on reading something like the RSI or reading something like the Stochastics or the MACD, and they are basing all their trading decision on these indicators whenever one of those indicators is giving them a signal. What they really need to become accomplished analysts about is looking at the price itself. These indicators are nothing more than a derivative of the price. Okay, they will always be calculated after the fact, including if you come to Elliott Wave. The problem with Elliott Wave is an Elliottian will become somebody that will predict a market direction or will predict the extent of the move. He would say this is a 38% retracement or a 61% retracement, and now the extension is going to go up to 1.618. Now he's playing that somebody has a crystal ball. That is not trading. Trading means that you get into the trade, you quantify your risk, you identify your risk, and then you start taking the move. And if an indicator confirms what your decision is all about, then fine and well, all the power to you. You can do, but like what John's saying, some back testing so that you can see which is the valid indicator for the time being, but you cannot, for example, use the same indicator all the time. You cannot use a stochastic and an MACD and a moving average on the same chart. That is fundamentally not correct, because a stochastic and an RSI are oscillators. They identify for you overbought and oversold. The MACD and a moving average, these are trend following or momentum indicators. They do not work at the same time correctly, and you guys can try. You can put them both on the chart. You will find contradicting signal when the market is trending. So you need to understand what the price is doing. If the market is trending, and now I'm getting an explosive move, that market can technically stay in an overbought condition indefinitely. You can stay indefinitely in an overbought or an oversold. You are going to get all those signals from the RSI and the stochastic, and if you take this sell signal, it's going to hurt you. So knowing what the price is doing, knowing what the chart is doing, and knowing what the market condition you're in, you apply the proper indicator to validate and confirm your decisions. So as John said, understand what these indicators do and understand the theory behind them, but more importantly, understand the application and the market condition that they should be properly applied. Michelle?
Yes, thank you, Mike. And Shaun, would you care to add anything in? I'd be interested to hear your perspective here.
I agree with Mike there about the RSI and stochastic. I've gone and seen thousands and thousands of professional traders over the years, and I can pretty much tell people that most people have a chart that has a moving average, a stochastic, and an RSI and an MACD on it. There is an inherent flaw in the stochastic and the RSI. What that is that it has a limit of scale between 0 and 100, and of course price action in theory doesn't at all. And so if you were to call up any real time frame chart, and we've been trending upwards quite strongly, you will see on a stochastic it only really needs one bar or one candle to actually have a down close to actually make the stochastic cross down because of the skew in the indicator. And personally, I quite like the fact that stochastics especially are so widely used, because I can take advantage of the crowd following that I know goes on. I can take advantage of the fact that a lot of people misinterpret, as Mike said, when to use it. And so I don't use the RSI and the stochastic in any way to quantify overbought and oversold, because it has that inherent flaw in it. In terms of Elliott Wave, Elliott Wave was something that I looked at in about 1985, 86 as technicals started coming in. I had Prechter's newsletter, and I studied it quite a lot, and I came to the conclusion that really all that Elliott Wave did was place a count retrospectively on something. It didn't appear to me to have any predictive powers, and the problem you have with Elliott Wave is what is the time frame chart that is dominant. So you could be in a grand super cycle looking at a monthly chart, but that's not of much use to me as a day trader. Am I looking at a 15-minute Elliott Wave count, or a 30 or a 60 or whatever? Also, when you see commentaries, quite often they might be saying that it's an ABC correction, and then the market starts trending, and suddenly it's become a 1, 2, 3 trend. So I did some work on, in my book, I think in chapter 3, I do a thing called stochastic steps. It doesn't have to use the stochastic, but what it does, it has a method of understanding what is the trending time frame. And one of the reasons I designed that was specifically for Elliott Wave traders, even though I'm not one of them myself, because there's various times where Elliott Wave becomes very popular, and I get a lot of questions about it, and so I had to find something that was going to help them to tell them what is the time frame that they should be using the Elliott Wave on. And that sort of helps in terms of knowing where is the dominant count, but still I don't use Elliott Wave in any way. I also agree about momentum indicators. I very much look at the price action, and so the market can be overbought or oversold for a considerable period of time. I literally look at the bars and the candles. I'm very interested in dojis after we've been trending very strongly, even if it's on a 5-minute chart or a 10-minute chart. If I'm not trading foreign exchange, I'm interested in high volume with a doji after a trend. That just tells me that suddenly buyers and sellers are having a tug of war. It will tell me to tighten my trailing stop and consider exiting completely. So I think price action is very, very important, and also you must understand the indicators that you are going to experiment with. So very, very important that you understand their limitations.